Mike will go in about 1 minute or so.
Great. Sounds good.
Good afternoon. Let's get started. We don't have a speaker next week. It's actually a special event known as the Student Research Showcase that we have once every semester. 2 or 3 graduate students will present their cutting-edge research on various aspects of energy. We have had great success with that, and the idea is to catalyze interaction on research and inspire some of our students, undergraduate and graduate students in the audience, to take up more energy-related research. It's a great pleasure to introduce to you and welcome my former colleague, Mike Jackson. Mike is a partner at the Wesley Group, where he has led many of their investments in Cleantech firms. At least a couple of them have IPO'd on NASDAQ, and some others have been acquired by other companies. So very successful. It's a very important area because there are policy questions, there are questions about markets, innovation. It's really convergence of some very important issues, and so we're particularly delighted that Mike could take some time to discuss some of those issues and his own experience with us. Prior to joining the Wesley Group in 2009, Mike was the co-founder and CEO of Village Green Energy, which is a retailer of renewable energy production to households and businesses. And prior to Village Green, that's where Mike and I actually first met, was at the Program on Energy and Sustainable Development at Stanford University, where Mike used to lead the India program, and he used to think about, write about, and teach about how global coal, oil, and gas impact energy choices in the developing world. Mike holds a double bachelor's degree in biology and earth systems and a master's in energy engineering, all from Stanford University. It's a great pleasure, and please join me in welcoming Mike.
Great, thanks, Varun. The big question on my mind though is where is the ponytail? When I first met Varun, he had much more hair, so it's great to see you. It's been a little too long. So I'm going to pull up my slides on the screen. I didn't want to take up the whole time talking. Wanted to make sure to leave quite a bit of time for questions at the end. If there are any questions that come up over the course of the presentation, I'm not sure that I will be able to see you when that's happening, so just give a holler, and I'm happy to address anything as we go along. But otherwise, I'll leave plenty of time for questions at the end, and would love to just hear some of your thoughts, because we're talking about an issue that's evolving pretty quickly right now. And something that would value the input of other folks about how we should be thinking about these issues. So what I'm going to do is I'm going to pop up my presentation right now. So holler to confirm that you guys can see it.
Yeah, we're going to put it on big screen. Okay, your presentation is up now.
Excellent. Great. So as Varun mentioned, I'm a venture capitalist. I work at a firm here in Silicon Valley called the Wesley Group. We invest in companies in the clean tech sector. We've been around since about 2008. We raised our first fund in 2008, invested in about 20 companies, and raised a second fund last year, and have invested in about 10 new companies out of that fund. So we're kind of active in our second fund right now. Then generally what we do as a venture firm, kind of where we fit in the broader landscape, is we look for companies that usually have a product that's in the market today. We're not usually a super early stage investor looking to take a ton of technology risk. Our firm is more a firm with a background in sales and business development, a background in markets and marketplaces, and we spend a lot of time helping our portfolio companies build up their management teams and kind of position around sales strategy. And so that's kind of where we fit in the broader landscape. We were fortunate to be investors in Tesla Motors in our first fund, which is certainly our most well-known portfolio company. We were also investors in Amyris, which is a company that went public in 2010, as well as investors in a company called China Recycling Energy Corporation, which is a Chinese company that listed on a U.S. stock exchange. Have a bunch of other interesting and exciting companies that I'm happy to talk more about at the end if there's interest. But I guess the way to just start is to give a little bit of a background on what the world has looked like as a Silicon Valley venture capitalist over the last few years, because it's been a pretty eventful time for me being here for the last 5 years. So, little history. Cleantech as a sector really began taking off in the kind of early mid-2000s. I graduated from undergrad in 2004, was kind of considering getting a PhD, and so from 05 to 07 was working in the academic side, and probably ultimately would have gotten a PhD if not for the way this curve looks. The private sector around energy, and particularly clean energy, was really starting to take off in 2006, 2007. You can see the number of new investments each year was rising dramatically. A big spike in deals in 2008. And there was just a huge amount of momentum and interest and excitement around the sector. A whole bunch of companies were funded. I think in one of these years, maybe it was 08 or 2011, Cleantech was actually the most funded sector of venture capital dollars that year. So really just came out of nowhere and very, very quickly took over a huge amount of interest and attention within the cleantech sector. You had firms like Kleiner Perkins, who's a very well-known venture firm out in Silicon Valley, deciding to open a very large, but also a number of companies throughout.
Mike, can you hear me? Seem to have lost him. Can you hear me?
Throughout the tech industry, this is John Doerr. You had among our firm, Steve Wesley, also standing among you. Can you hear me?
Yeah, we can hear you now. Can you hear me?
Can you hear me?
I can hear you now. Are you able to hear me?
Yeah.
Okay. Let's try again. We cut out for a minute there.
Yes.
Go ahead.
Sure. Where did I lose you? Where did I lose you?
Kleiner Perkins. I think we were about there.
Where did I lose you?
Can you hear me? At KPCB,
so,
we heard that.
So, Kleiner Perkins decided to open. Great. Are you able to hear me, or am I cutting in and out?
There's a lag, but we hear you now. Go ahead. There's a lag, but we hear you.
Great. I'll just keep talking. I'll assume it's working. Just give a holler if it's not. So Kleiner Perkins, perhaps the most famous venture capital firm, entered the clean tech sector. Vinod Khosla, also a very, very famous entrepreneur in Silicon Valley, raised $1 billion fund to invest in clean tech in 2009. And you had our firm, the Wesley Group, was started around this time in 2008, and opened our initial fund of $120 million, which is a very large first-time fund. So you had a whole bunch of venture investors piling into this sector, a whole lot of interest in it, and that drove this growth in clean tech investing. Obviously another very major part of that process was Obama getting elected in 2008. You had a very green-minded president coming in, a lot of thought that we would see a carbon policy during Obama's first term. We had a stimulus package that allocated tens of billions of dollars to the sector. And so this was probably the most exciting sector within the venture capital community in the late 2000s around this kind of overlay of government, and it was sort of a new big thing. Then a couple of things happened towards in the early part of the 2010s. The first is we had a very, very high profile bankruptcy in Solyndra. This became a political football for a lot of entities. It exposed a lot of concern around the DOE stimulus program. Certainly, people argue back and forth about the merits and demerits of investing in a company like Solyndra. But this was a major, probably attempted scandal on the Obama administration. You had substitutes entering the market. Fracking became a much more substantial piece of the U.S. energy mix around this time, and people started saying, gee, we thought oil prices were going to rise and rise and rise, and actually there's now a long-term downward pressure on oil and gas prices in the U.S., so maybe we don't need this new clean technology. And lastly, we saw substantial competition coming in from China, particularly in solar manufacturing, which was a major part of that initial wave of clean tech was in solar companies. And so that dropped the price of panels. That helped lead to the demise of Solyndra and several other companies. And it really took a lot of the luster off of the initial excitement around clean tech. So that's what the world sort of looked like in about 2012. And as you can see, the result was a huge decline in capital invested in clean tech, a huge amount of the number of deals that were actually invested in. At the same time, when you look, so across 3 years, you see just a steady decline quarter over quarter in clean tech. And probably the story is actually even worse than these graphs show, because as the graph on the right indicates, most of the deals that were actually being done were actually follow-on investments rather than initial investments. And so if you were to look at new investments being made, the situation would look even more bleak. And so in about the 2012 timeframe, 2013, and increasing into today, there's a lot of pessimism around, gee, venture capital doesn't seem to really work for clean tech. Clean tech is dead. A variety of kind of the sky is falling or the sky has fallen statements around this sector, and just it was a pretty brutal time. We were fortunate, as I mentioned, to have been investors in Tesla Motors, which is a pretty successful investment, and so we were actually able to survive this era and raise a second fund. But there were very few of our cohorts that were able to, and if I were to go back and look at all the venture firms that we looked at investments with in 2007, 2008, 2009, a small fraction of them are today actively investing in the clean tech space. And this is just kind of a conceptual graph, but the general consensus, if you were to talk to most folks on the street, is they would say, yeah, clean tech, it kind of rose in 2011, and it's kind of petered out from now. That whole solar thing kind of failed. We used to be excited about this, but renewables haven't really done anything, and they're probably on the out, and that was maybe a fad. This is probably what most people you may talk to who are outside of the energy space would say about what's gone on in clean tech over the last couple of years. The reality is completely different. While folks didn't make a whole lot of money in that initial run-up in, for example, solar, we deployed an enormous amount of capacity. The solar industry in the U.S. has grown 7x in the last 5 years. We have been very, very successful at deploying systems. We've seen prices come down dramatically. This graph I could repeat for just about every technology. Smart meters have seen a similar rise. LEDs have seen a similar rise. They're probably a few years behind these others, but will probably take over their will certainly take over their incumbent industry dramatically faster than even solar will, and pull a huge amount of energy demand off of the grid. The other nice thing about lighting is you're typically switching out your light bulbs, every couple of months or a couple of years, depending on the application, and so you don't have this big embedded infrastructure that's slow to be replaced. So the global lighting market is soon to be dramatically changed by the evolution of LEDs, which don't have any of the trade-offs that fluorescent light bulbs do in terms of lighting quality and dimmability. They're kind of the best of all worlds, and at this point, for a lot of applications, they're actually at cost or have a very, very short payback. So a very exciting development. So what we've actually seen is, although that first wave of investment in clean tech failed to generate the super exciting returns by and large from the investor world, and there's been a very large pullback from the venture capital community, that wave of investing was massively successful at getting stuff deployed. It was an amazingly good thing for the climate. It was a bad thing for folks in my shoes who were trying to profit off of it. And so that's kind of where the world is today. That said, over the last year or so,
We're cutting out a little bit, Mike.
Time to get out of clean tech. Tesla has gone public. Solar City has gone public.
I think there's a long lag.
Nest was acquired by Google. Can you hear me?
We can hear you. There's just a bit of a lag, and it was cutting out for a minute.
Can you hear me? Okay, great. So I was just saying on this slide, just at a time when every everybody started to say clean tech is dead, pulled out clean tech specialist failed to. That's fine.
Okay, Mike, we just got you on the phone now, but you can keep going through your slide.
Great, and you can hear me okay right now? Does that work from an audio perspective on your end? Does that work? I'm on a wireless connection.
Yeah, they can't. More than just getting you right now. That can't. It's only just getting to him right now. That latency isn't.
Sorry, can you say that again?
Can we just try it? Let's sit down for a
1 second.
Just one.
Hey, Mike, can you hear me? Hello? Yeah, barely.
So I have it on.
I turned it off the speaker.
Yeah, you won't hear it.
Oh, okay. Sorry.
Okay, we're going to try something else, Mike, because this with the wireless connection, there's a delay.
Yeah, you can't do this kind of connection on a wireless network.
Okay, what can we do?
Just if there's a wired connection for the.
Do you have any way you can connect? Oh, he's not on his phone. Did you put his phone down, or is this on a delay too? Can you hear me?
I can hear you.
Oh.
Okay. Yeah.
So he just needs to.
Yeah, if possible, if you can go on a wired connection.
Okay.
If not, there isn't one around, I mean, it'll just be latency like this for a little while.
So why we didn't have any problems with it?
I mean, just over time, it's a lot of bandwidth to go through.
Sorry about that, guys. We'll have this back up in a second.
Yeah, we'll get it going.
Okay, Mike? Can you plug it into, do you have a connection there that you can plug it into for internet?
Talking about my computer or my cell phone?
Your computer. Do you have any kind of internet cable, Ethernet?
I don't know that I do actually.
I mean, it'll be some latency, but I mean, it's workable. You guys are cool.
Just
with
keep it how it is?
Yeah. I mean,
Okay, could you put the mic back on there?
all right, sure.
Thank you. Well, we're going to try to keep going as it is. And when it cuts out, I'm just going to let you keep talking. It only cuts out every once in a while. So, sorry about that. So, yeah, we'll just go back. You just switched graphs.
Can you see my screen?
He's going to request it.
Oh, okay.
Okay, Mike. Go ahead. We're getting you up here.
Okay. Can you see, let me know when you can see the PowerPoint?
Okay, I hear you loud and clear now. We're waiting for the PowerPoint to come up.
Great.
Do you want to try re-requesting shared screen?
Yeah.
I think I hit share. It says my
Yeah.
screen is being shared. Yep,
Okay.
let's try it again.
There we go. Now it's thinking.
It says I'm sharing my screen. Do you see it?
Not yet. He's changing the settings here. What if you clicked on that too?
It's sharing my screen. I don't know. Yeah.
Having some technical difficulties here.
Yeah, we're just not getting any screen.
Okay, let me see it for a second.
That's gonna take control of the computer.
Okay. Well, I guess just have him talk then.
Hold on. No. It should be.
It says my screen is being shared and controlled by Alexis Mendez.
Your PowerPoint is up though?
It's up on my screen, yeah.
Okay.
It keeps popping up and down the offer to share my screen, which I keep clicking and saying yes.
I'm gonna stop the webcam right now. Or stop the webcam, I should say. Just one more time on this. Yeah, it's just not getting it.
Okay. Well, he can just talk without that.
Yeah. I mean, if you wanted to do that. But,
Do you want me to try to rejoin the meeting?
yeah, that would probably.
That's probably the best if we could do that.
Great, I'll do that.
All right.
Thanks for the patience, guys.
Yeah, thank you.
Wait for 2 minutes.
Yeah. I think we should discuss last time is pretty much quick connection for for high definition video sharing, and as well as content sharing simultaneously. Just in case we have to do this again, later in the semester. See what I'm reading.
There we go.
But yeah, it needs to enable microphone. Okay, we got your screen, but we just need to get your microphone.
Microphone looks like it's on.
All right, there you go.
Great. All right, we're back up.
Back up.
Yeah, we've got your PowerPoint on full screen.
Great. So what I was saying is kind of in the midst of all of that pessimism around Cleantech, we started to see some really exciting exits. It seemed like perhaps the venture capitalists had given up and thrown in the towel maybe a little too soon. You had the Tesla, the Solar City IPOs. We had Nest being acquired by Google for over $3 billion. And in the case of Tesla and Solar City, it may be a little hard to see in these graphs, but you saw huge run-ups in their stock price. Tesla at one point was, I think their share price hit a low of about $17 a share, and today is somewhere in the range of $230, $250 a share, just over the course of about 2 years. Solar City has increased 6 or 7x since going public. And so all of a sudden you had these multi-billion-dollar clean tech companies that were venture-backed, had done quite well. The investors in Nest, again, had done quite well. And so all of a sudden this sector has started to get a little more interesting to folks, and we're emerging from a time when clean tech was the least popular, least sexy part of the industry, to people starting to say, gee, so it turns out you can get some really big exits, and when one of these companies hits $1 billion in value, it's actually just getting started because these markets are so huge. And at the same time, there's not a whole lot of competition in this market today. So a lot of the fundamentals of investing in clean tech all of a sudden have started to look really quite good. So I'm going to talk a little bit about what went wrong in the last round of clean tech and what are we going to learn for this next wave. So I think the first is that it was actually just structurally difficult to invest in capital efficient clean tech in 2007. If you were looking at the software industry today, you have to realize that industry couldn't have been built without building capital-intensive things like we see on our left. So companies like IBM were a precursor and a necessary piece of building companies like Facebook. Facebook can't exist until you've deployed that enormous infrastructure of computers all over the world. Now, Facebook, obviously, from a venture capitalist's perspective, looks like a much better investment. It doesn't need a huge amount of money to scale extremely rapidly. But computer companies were somewhat of a necessary evil to lay that foundation. And I think we're starting to see the same thing in a wide range of clean tech sectors. So one way to think about the solar market, for example, is if you looked at the solar market and you in 2006 believed that solar was going to become the next big thing, your only option for investing in $1 billion market was to invest in a panel company. The industry just wasn't that big, and the only types of companies that were out there were panel companies. So you needed a First Solar, you needed a SunPower, and you needed even a Solyndra in order to be able to eventually invest in companies that are much more capital efficient. Companies like Enphase Energy, which makes microinverters. It's kind of a proprietary piece of small hardware, far more capital efficient investment than traditional panel manufacturing, still a hardware company. Or companies like Solar Mosaic, which is a crowdfunding company in the solar market, which is essentially a software company. They've raised a couple of $1 million in venture capital funding, small team, but are able to reach a very wide impact. Lastly, companies like KWH Analytics, which ultimately analyzes the performance of solar systems in the ground and identifies which technologies and products actually work better than others and what that distribution of performance looks like. You couldn't have invested in a company like KWH Analytics 8 years ago. Their market size would have been $2 million. The opportunity was just far too small. But as the market for solar has run up so dramatically, these niche plays within the solar market have all of a sudden become kind of interesting multi-billion-dollar markets. And so that's what we're starting to see as this market has grown. I could have again made this figure for a wide range of other industries. In wind, if you wanted to invest in the wind market initially, you're going to be investing in turbine companies. Over time, you can invest in small incremental pieces of a gearbox. You can invest in wind measurement. You can invest in wind performance analytics, which are the types of opportunities that only become interesting when the market becomes big enough. But we've started to get to that point with a wide range of these industries, and so you're starting to see that the models that exist now look a lot more like venture capital style investments, where a small amount of money is needed to be raised to create a huge amount of value. So just to kind of put that on a figure, over time as the solar market has grown, in the early days, really the only thing you could invest in was panels. Over time, as panels become a bigger and bigger market, you could invest in something like an inverter, which might make up, a couple of % of a project. After that, financing companies like SolarCity start to look interesting. We're seeing a lot of companies now in solar whose entire job is to produce lead generation for solar companies. Kind of an unheard of idea as a huge opportunity 5 years ago, but as this market continues to grow, as the low-hanging fruit of customers have already installed solar, and these solar companies are trying to find more and more customers, this is emerging as a large market. And analytics, companies like KWH Analytics, that only make sense when you have thousands of systems deployed. So over time, we're able to invest in these different industries that only become unlocked when the market becomes very, very large. I think another mistake that was made in the first wave was there was an emphasis on market size rather than business models. So everybody liked to say, geez, this energy in the U.S. is $1 trillion market. That is so exciting. Did I mention it's $1 trillion market? The internet advertising market, which supports an enormous amount of software venture investing in the U.S., is a $42 billion market. It's a tiny fraction of the size of the energy market. And so this figure is what drove a lot of that initial investment in energy, saying the market's really big, so therefore this is a great opportunity. But the reality is that if you're a small company, it doesn't matter how big the market is. You need to figure out how you're going to get your first 5, 10, 20, $50 million in revenue. And it doesn't matter that you could grow into having $500 million of revenue or not, because you need to have the path to get there. And for a lot of these companies, the path to getting your first $10 million in revenue involved an investment of hundreds of millions of dollars. And so what's probably interesting about this, though, is that this premise is actually a really strong premise for late-stage investment. It's a kind of a reason that explains why Tesla and SolarCity have done so well in the post-IPO market, because now they've emerged as a leader in a market with a proven model, with no competitors, and the ability to grow to tens of billions of dollars in revenue without a real credible competitor in sight right now. And so I think that's part of why we've seen that run up. I think another reason why we had what we had before was there was lots of follow-on investors for our deals. If you're a Series A investor and you look out at the Series B, C, and D investors, and you see that they're swimming in cash, they have an enormous amount of money, that tells you I don't need to worry about the fact that this company I've just invested in needs to raise $200 million, because there's people there who are willing to invest in it, there's excitement around it, so it's okay if this isn't a capital-efficient company. So where we've landed now are some of the new rules of clean tech investing. We're going to cover these 4 rules, and I'd love to hear some thoughts from all of you about what other ideas you have in terms of reasons why things maybe went awry last time and rules we might want to apply in the future. So today the world looks a little different from before. Now if you're a Series A investor, you're looking out at the future and you're seeing not a whole lot of money. And so whether you like it or not, you have to invest in companies that are not going to need a whole lot of future money, because you're taking a huge amount of future financing risk. And so the market has adjusted to this. It's not that we're smarter than other people, but it's looking out at your future sources of funding and seeing that I need to be smart about what I'm investing in, and I probably can't fund a large capital-intensive company. And so, interestingly, I hadn't quite realized how striking this figure would be, but this graph shows the companies that we've invested in our second fund. Now, these are all clean tech companies, but I think clean tech has come to mean to a lot of people big capital-intensive energy companies rather than technology companies that clean the environment. And so when we look at our portfolio, we see that we've invested in a number of companies, pretty much our entire portfolio in this most recent round of investing have actually been software companies. They need a few $1 million to get launched. They don't need a tremendous amount. So I think we're 8 to 1 investing in software companies that have a much more capital efficient business model, all still create that strong environmental impact, but probably ultimately have that easier path to get there than, hey, at some point I need to figure out how I'm going to raise $200 million. So what we've seen is that first wave of of clean tech was solar PV, wind, cellulosic biofuels, where companies maybe needed hundreds of millions of dollars to get to where they're going. Over time, into smart grid applications, energy efficiency, where companies needed tens of millions of dollars. This was probably the world of 2012, 2011, 2013, to a time now where people are investing in things like clean web companies, energy IT applications that may need millions of dollars to get to where they're going, and typically have really attractive gross margins. So this is where the industry has evolved over time. I think the second thing is that we've found really cool niches within the energy space. We talked earlier about the solar market and the niches that were opened up there. This is a company called Simple Energy, which essentially creates incentives for people to reduce their energy use and tries not to have a conversation with customers saying reduce your kilowatt hours, but hey, if you turn off the lights and you're good at saving energy, we'll give you rewards points, credit card rewards points, we'll give money to your local schools, and are trying to change the game and the conversation around what it means to save energy. This is a company that couldn't exist if Silver Spring hadn't deployed a whole bunch of smart meters out there. Silver Spring was a more capital-intensive company. Simple Energy is essentially a software company, but Silver Spring was a necessary precursor to it, but it's opened up this niche application for Simple Energy that today is a couple of $1 billion opportunity. Another thing that you're seeing a lot in the clean tech sector are companies that, so to speak, hug the trees by accident. They're not explicitly an energy company, but if they do well, it's enormously good for the environment. We invested in a company called Good Eggs, which the easiest way to think about it is Whole Foods has wrapped their brand around the word organic. Good Eggs wraps their brand around the word local. They create a marketplace for consumers to buy food directly from local food producers. They cut out the grocery store middleman, but ultimately have people buying food from within about 50 miles of where they live. I'm sure you've all heard and read quite a bit about the concept of food miles and how so much of our organic food comes from South America, comes from very far away. If you can create a marketplace of people who are obsessed with buying local food, that has a dramatic energy benefit, although not explicitly an energy company. And so Good Eggs is a company, because it's so scalable, that it has a really attractive opportunity to be one of the most impactful companies on the environment in our portfolio, even though they really are not an energy company by any way you could possibly define it. I think the last thing, and one that we certainly struggle with on our end to try to understand what to do, is there's a rebranding effort underway. I think, like it or not, clean tech means to people big solar projects, big biofuel projects, and probably in the context of those, big unsuccessful biofuel projects, big unsuccessful solar projects. And so a lot of people are trying to think through, how do we change this word? Yes, when we break it down, it just means technology companies that benefit the environment, but clean tech as a word has just taken on its own identity, and now to a lot of people just means Cylindra. So we're starting to see things like Cleantech 2.0, the sharing economy, Internet of Things, clean web, and we're having a birth of a new a new concept around this market. And so it's something that we continue to think about as we go out to our next fund of what, how we should position what we do, because it, like it or not, the brand certainly carries a lot of weight to it. So I'll stop there. Would love to see if there are questions I can answer, hear thoughts from your group, and just would love to have a little dialogue.
Not to beat a dead horse, can you hear me now? Can you hear me?
I can.
Okay. So, Mike, there's a delay. I'm going to pass the mic around, and if you'll just wait a few seconds after you see me walk around, you'll hear the question.
Okay, great. And I can't see anybody, but I think that's.
Hey Mike, this is Varun. I'll start off with a question. Very, very exciting. Thank you for sharing your insights. Exactly what I had hoped you'd lay the ground for. The question I have is, you do show this very interesting, in many ways a necessity to have laid the groundwork for the hardware, the steels in the ground, the backbone before the clean web or the Cleantech 2.0 can come in. So, directly related question would be, how does that happen? Who does that? What type of models exist? Does it mean that we'll have to have a lot of big clean tech early companies fail to do that? Or does it mean we need a lot of government support there?
Hello?
Yeah, can you hear me, Mike?
Sorry, you cut out just for a second. You said that the infrastructure was a necessary thing to be laid out for the Cleantech 2.0 world, and then you cut out right after that.
Right. So I can repeat after that. So basically, who does that? If the capital efficient venture capital firms can't do that, then how do we do that? And Cleantech is one. I try to think about other problems that we, as a society, as a country, as globally, we might face, and how do we fund those types of innovations?
Sure. So one of the things that we've seen, while we've seen a substantial pullback in clean tech investing from traditional venture capitalists, at the same time we've seen a huge increase in venture capital investing from strategics in this market, whether it is the GEs of the world, whether it's large utilities, large oil companies. They've all actually rushed into the market, in part threat that was probably.
Mike, it's frozen again. If you'll just give it one moment to catch up. Yeah, and just for the question and answer, might just have him call us again. Mike?
probably way off on the horizon, is much closer than they. Yeah, I can hear and see you guys perfectly on my end. Yeah, well, great. Okay. What's that?
Go ahead. We hear you now. You cut out right after you started answering Dr. R's question.
So what I was just saying is you're starting to see now a lot of companies, one, you're seeing large strategics realize that technologies like electric vehicles and solar are going to take over their markets sooner than they had previously thought. This used to be this distant idea on the far horizon, and instead now people are realizing these technologies are coming in much faster than they had previously realized. Renewables have so far this year in 2014 make up about a quarter of the actually generating the megawatt hours of what will be produced by of new technologies in the U.S. On a capacity basis, it's about half of all new capacity has been renewables, and when you even adjust for capacity factors, they're a quarter. What you're also seeing is companies like GE have assets in the solar market now, and so they are beginning to invest in innovation in those markets, and so you're seeing strategics play a bigger role. I think there's always a role for government to fund early stage innovation as well, and I think we'll continue to see that. We see a lot of that in, for example, the DOE Sunshot program, where they're funding innovation around reducing the soft costs associated with solar. So other people have stepped into that void. As these industries grow, you'll see Tesla will have a venture fund. You'll see Solar City will have a venture fund, and they'll be focused on reducing the cost of electric vehicles and solar.
Great.
Thanks, Mike.
Next question.
Hello, Mike. Great presentation. I wanted to ask you a couple of very quick questions. One was about a company that appeared on the scene about 4 years ago. I think their name was Absolute Black or something like that. Their focus was femtosecond blasts of lasers to increase the absorptivity of solar panels. And the great Cleantech benefit was to be that no bottleneck through the chemical vapor deposition machines for current technology, no toxic byproduct of silane and that sort of thing. What happened to them? Second question is for little fish, like some of us, is it possible to invest in groups like yours for $3,000, $5,000, $10,000? Thank you.
Sure. So on the first one, I don't know. I haven't heard of the company. I can try to check into it. It's called Absolute Blast. Black. Is that right?
Absolute Black.
Black. Okay. I'll see if I can find anything. On the second, in terms of investing, we are restricted by law, as are most of the companies that we invest in, to take investment only from accredited investors. And so what that typically means is there's some standards around a typical, it's a net worth of the investor. It's a couple of $1 million. If you don't fit that description, we're legally not allowed to take money from them. Neither would many of these companies. The typical investment minimum in a venture firm typically is about $500,000 as well. In terms of ways to be able to invest, there are some entities. There's a firm called Hercules, which is a venture debt provider that focuses a lot on clean tech. They're a publicly traded company, so they could be one to look into. But unfortunately, the options are not great. probably the last thing that I would say on that is there is potentially the ability to do something like a Kickstarter, but that's not an investment. You're not buying equity, and it's not really an investment. It's kind of a contribution, so not a great fit. It's something that will probably change over the next few years. There were some interesting innovations in and around all of that a few years ago in a bill passed by Congress, but I haven't seen a whole lot of actual change in the marketplace as a result.
Hi, Mike. My name's Eric. Thanks for your talk. It was very informative. I have a question, or I actually have two questions. First, based on kind of the overarching view of your talk, it sounds like the IT thing is a big focus. So my first question is, if the IT space in clean tech is what's most ripe for VC, that's the best fit, are there any exceptions? So that's my first question. My second question is, where VC is a good fit, are you expecting a swelling in sort of the VCs that have experience in energy and clean tech, or is it a good enough fit that new venture capitalists that have not played in this space before are now going to find it a close enough fit that they'll come in and want to play in that space as well?
Sure. So on the second point, we certainly are starting to overlap with investors that we didn't used to overlap with. I think the area where we do that the most are certainly in these companies where as I kind of jokingly said in the presentation, the trees are hugged by accident to it, huge energy benefit to it. But some of the other investors who are in that are ones that are much more consumer oriented, that have invested in other companies in the food sector. So we've certainly seen ourselves overlap with other entities there. We haven't seen thus far a lot of traditional tech and software investors coming after a company like, say, Simple Energy, which is very explicitly an energy company, but is ultimately in the IT space. Haven't seen as much of the call it a generalist fund expanding their practice to include clean tech with an IT focus, but a lot of them have one or two companies that certainly meet that description. I'm forgetting what your first question was.
Yeah, Mike, he was asking about if there are exceptions to VC investment in clean tech outside of what you mentioned in your talk.
Yeah. Yep. So there definitely are. There are. We've seen companies in doing financial innovation in the solar market. One of the big areas of interest right now is around community solar. So this is building large-scale solar projects in a utility scale, so a couple of megawatt system, truly those panels to homeowners that live in their project. Going to clean tech, master companies have been funded. A lot of people think that's the next wave of clean tech investing, and so we've seen a number of companies in batteries and storage.
Okay, one more question.
Hey, Mike, great talk. I'm an undergrad government student, and I'm just curious, for groups like Wesley Group, what types of lawyers are you guys looking to utilize the most? Like lawyers who can help you navigate government policy and regulations such as Obama's EPA policy, or government or lawyers that specialize in intellectual property or knowledge of clean energy and technologies, or maybe of the sharing economy, et cetera. Like, which types of lawyers are you guys looking to utilize most or work with?
Sure. So for us, we work most closely with two types of law firms. So one is a law firm that specializes in kind of the overarching fund structure. They would work equally well with us and any other venture capital firm. Just basically our relationship with the investors in our fund and how we structure ourselves internally. We have a law firm that we work with that focuses on deal structuring and how we interact with our portfolio companies. They're a very large law firm, big global presence, and so our primary contact there mostly is involved with, we're investing in a new company, we're negotiating the terms of that investment, but if there's an interesting IP issue around it, they are able to essentially connect us to the right part of that practice. So it's one of the benefits of working with a larger firm is a wide range of things kind of come up. And so we work with a very large, essentially generalist firm. A big part of our fund's overarching background is in government policy. So Steve Wesley, who's the founder of the firm, was formerly the chief financial officer of California. He was a state controller, sat on the board of the large pension funds in California, and so is very, very familiar with government policy, how a lot of these issues work, and has a really strong Rolodex of folks that we can call on to help answer some of these sorts of questions as they come up with our portfolio companies. But a lot of it is just doing our own research, calling around, seeing who we can talk to that can help us answer those questions.
Mike, I have a quick question. You mentioned how over this past several years the nature of clean tech investing has changed. That first they were the larger projects, and then you moved towards IT. I'm curious to know, as we saw with, say, wireless, we did then have a second round of infrastructure build out with like Wi-Fi, for example, and broadband and so forth, which isn't working very well today. But I'd be curious to know where you see clean tech going in the next couple of years with regards to these projects. Are we going to see more infrastructure back, perhaps more efficiently designed companies in infrastructure?
Yeah, so one area that I remain very optimistic on and think we will see some pretty interesting developments in over the next couple of years is going to be in biofuels. The initial investments in kind of cellulosic biofuels, by and large, were not all that successful. But there are a couple of companies that have just brought online or are just about to bring online some ultimately what appear to be fairly successful cellulosic biofuel plants. And I think in the public markets right now, people are very pessimistic about this market, I would say irrationally so. And I think there's going to be a moment over the next year or two when one of these companies turns on a large plant. It works quite well, and folks say, "Oh my goodness, I forgot that this is a $30 billion market and nobody else can do this technology, nor can anybody else raise the money to even attempt to compete on this technology, and you have a huge structural advantage over the rest of the industry." So I think we're going to see a resurgence in interest around biofuels because I think we're going to see a couple of successful companies there. The one I will plug, which is a portfolio company of ours, full disclosure, which is just finished construction of its first large-scale commercial plant, is a company called Enerchem. It will sell ethanol produced cheaply, and selling into some very, very large, I think, excitement that we saw out of companies like Tesla and Solar City, because they're to some extent the last one standing and ultimately successful. Outside of that, I think you're going to see some of the companies that are part of that first wave of deployments investing in the infrastructure that will enable them to continue to be successful. So you see companies like Tesla Motors, for example, investing in charging infrastructure because it makes their cars more valuable. They don't necessarily want it to be a car charging company, but they've installed charging stations all up and down Highway 5 in California, and nobody would have done that as a gift to the electric vehicle industry, but as companies like Tesla have grown and become successful, they have an incentive to invest in the underlying infrastructure that will enable their continued growth. So I think you'll see the large new players like Tesla and SolarCity and Nest and others invest in that infrastructure that will enable their continued growth.
We have time for one more quick question. Yep.
Hi, Mike. Thanks for coming, or thanks for speaking. I just wanted to see if you could expand. You mentioned it briefly, but just as far as innovations in storage and I guess just battery technology, I just wanted to know sort of your forecast for storage.
Sure. So what we're seeing now is we're seeing a lot of companies that are building applications around storage. So as prices have come down, we're still starting to see a lot of people who are installing behind-the-meter storage buildings where you're getting the demand charges, assuming everybody is familiar with demand charges charged for the that energy in those locations and building the software that helps them follow a load very accurately. I hate to beat a dead horse on this as well, but I think the most interesting company in the storage market right now by far is Tesla. Tesla buys half of all of the last stationary storage. It doesn't matter because they're buying it at a 1,000,000x scale of what the ideal chemistry is producing at today. And so they have entered the stationary storage market and are beginning to deploy systems. I think the three main advantages that all of the companies in the stationary storage market want. The first is really cheap behind the meter customers and say, would you like to have our product in your building? And third is they have access to financing. What's probably going to happen in this market, like we had in the storage market, is it's really going to get unlocked when a company like SolarCity comes along and says, no money down, we'll pay. Shed your demand charges. Think of it like an public stationary storage over the next 2-3 years.
Mike, thank you so much. This was very insightful, and thank you also for your patience with all the difficulties we had with the technology, but we learned a lot. Thank you so much for your time, and I look forward to catching up again. Thanks.
Probably mostly my fault. Great. Thank you.